Did you know there's two types of markets out there? There's what's called a bull, and there's also a bear. And the easiest way to remember this, I tell every client, if you look at a bull, it attacks you going up, right? It kind of runs at you with its horns and it pushes you up. That's a way to remember that this is a up market. A bear, on the other hand, attacks you clawing down. Right? So they come at you with your claws and attack you, it goes down. So that's the easiest way to remember a bull versus a bear. Another great part about this analogy and understanding, by the way, this is not why they're called bull and bear. There's a bunch of different explanations out there. The reality is nobody actually knows where the original names bull and bear came from. But a bull, if it's attacking you, think of the running of the bulls, it can run for very long periods of time. And that's what happens to the running of the bulls. You don't hear about a running of the bears. You hear about a running of the bulls. So bull markets are longer, historically, and bear markets are shorter. Think about when a bear attacks you that claws down. A bear's going to attack very aggressively and very short, and then it's going to run away. That's how bears are. They tend to go down fast, and they tend to be shorter. And there's all different statistics of how long these are and how short these are. It depends on how you define them. But traditionally, a bull and a bear is when the stock market is down 20% from what we call peak to trough. It depends on what market. We typically are going to look at the S&P 500 or Standard & Poor's 500 index to decide whether there's a bull or a bear, but it really depends on the market you're in. So if you're in commodities, there could be a bull market or a bear market in that particular commodity. Think of things like corn. Think of things like gold, or commodity markets are going to be different than the stock market. The bond market's going to be different than the stock market and different stock indices. In 2025, the S&P 500 was down just over 19% at one point. But there was other indices that actually got over 20% and hit a bear. When you think of market cycles like this, that's called a peak when you get to the top. This is called a trough when you get to the bottom. And so what we're measuring is that peak to trough, that distance. If that goes down by 20%, it's a bear. Why is this important? Because it helps you understand what's going on. One of the things we always like to say is we don't believe you should time the market. What's more important is time inside the market. However, if you find an instance where the market is down by 20% or more, these are relatively rare. So when we start thinking about it as defined by the S&P 500, 2025, at the filming of this in July of 2025, there was not a bear market in 2025. Came really close as defined by the S&P 500. We go back to 2024, there was not a bear. We go back to 2023, there wasn't a bear. 2022, there was a bear. And just for the sake of this purpose, let's go back to the next one, 2020. What was that? That was COVID. Very, very short bear. Second shortest market as defined by the S&P 500 outside 1987. Prior to that, you have to go back to 2008. Prior to that, you have to go back to 2000 and 2001. That was the dot-com bubble and the terrorist attacks. Prior to that, you have to go back to 1987. So these don't come around too often. When you do see one of these, for clients that understand this, this is when you want to make some strategic moves. These are great to take Roth conversions and pay taxes at a lower amount. It's also a great time to take any cash you might have had on the sidelines and accumulate it, or run lower cash reserves to get a little bit more aggressive. Maybe if you were more conservative in your portfolios, on a scale of 1 to 10, you have a 5. Maybe you want to go up to an 8 or a 10, and these bear markets to take advantage of them. If you want to understand more about bulls and bears, and you want to understand how we work with our clients when we're doing investment management to take advantage of bear markets for our clients, we would love to talk to you.